Well, we talked about it a lot this morning, how the grain markets stepped right off a cliff last night, and that move sped up here this morning on the open. Now, about 20 minutes ago, things are starting to levitate a little bit. Interesting how they really maybe got all the selling out of their system, or maybe they're catching their breath for another run down. We'll wait and see. But anyway, here is the latest information with our quotes provided by Bar Chart. Here we go. July corn now down 19.5 cents at $6.65 per bushel. You still have December down 26 1/4 at 5.83 1/2, but it's off of its overnight low by 13 cents. On the soybean side, yeah, it's been a hard sell day today, but you have July soybeans now at 14.72 1/4. It's down 36 1/4 cents. But 14.72 is much better than the low where we were earlier at 14.55 if you're a producer. So that means we have bounced off of that by 17 cents now already. Now, November down 42 1/4 cents at 13.96 1/2. That's right. I said it had a 13 handle on it, but that's off of its earlier low this morning around the open when it was as low as 13.81. So it's bounced off of that by about 16 cents already. All kinds of volatility in the markets here. In the wheat, in Chicago, July down 10 1/4 at 6.70 1/2 per bushel. In Kansas City wheat, we have July 14 3/4 lower at 6.23 1/4. Now, keep in mind, with those high temps that Tim Ross was just talking about in the plains, the wheat harvest will more than likely be picking up big time this week. Spring wheat trade in Minneapolis has July 18 3/4 lower at 7.46. But that's 16 cents off of its earlier low. Let's bring in Chris Swift of Swift Trading in Nashville and talk about all this. Big gyrations going on this morning here, Chris. What does that all mean in the bigger picture?
Good morning, Marlon. Well, it'd be nice to know if we had our crystal ball out and clarify and see what all, but in all honesty, it looks to me like maybe just an adjustment in the money flow. We've seen all the commodities kind of take a little bit of a breath this morning, and then we come in, after really no rain anywhere that's going to be of any benefit to the areas that are in detriment. Now we're starting to pull up off the lows again. So I think you got a little bit of a spook from maybe some of the Biden administration's ethanol verbiage we heard on Friday. No really horrible weather, in the good part of the Corn Belt, and more bad weather in the worst part of the Corn Belt. Kind of just even things off a little bit. Traders got a little bit nervous. I think this morning they're going to come back in and be buyers.
Now, I mentioned earlier where on the crude oil trade for the West Texas Intermediate crude, it has been trading higher today. And right now, July futures are 78 cents higher at 71.69 per barrel. Now, while the those RINs and the exemption allowances for the refiners have been talked about a lot here lately, the fact that the crude oil market is higher should offer a little bit of spillover support here to the corn market, you would think, this morning.
Yeah, you would sure think so. Gasoline is unchanged on the day right now this morning. So anything that has to do with the energy aspect of it should be a benefit to the corn. And we've seen the energy aspect just continue to move higher and higher as more and more people have money that the government has been so graciously giving out. So they're spending it.
Wanted to take a look at what the dollar value is doing today, and on the U.S. dollar index, June futures currently down just 45 points at 90.505, so basically holding the status quo. We'll come back in a moment and take a look at our livestock trade, see how it's holding up in the early going today when we come back. We're talking with Chris Swift of Swift Trading in Nashville. And as we roll over and take a look at our livestock trade right now, let's go to live cattle and our quotes provided by Bar Chart. August live cattle, 75 cents higher at 120.77, about where they were last time we looked. October up 40 cents right now. On the feeder side, you currently have the August contract up $1.90. We're now at 153.07. Off of our earlier high of the day, though, by nearly $1. They're really kind of backing up on the early gains that they had here. Generally, over $1.50 higher across the board on the feeders, though. Lean hogs, you have July down $1.07 at 118.90 per hundredweight, and this is after an early high of 119.65. So the lean hog market still continues to struggle here. On the other hand, you look at the cattle market, and it is higher today, but I want to go back to Chris Swift here and talk about this a little bit. They're talking really hot temperatures in the southern plains, or the high plains, I should say, this week. Is that going to be overall supportive to the cattle market? I mean, it could impact those weight gains.
It could. I don't know how supportive it'll be really towards it because we still are so low on our slaughter capacity. We were anticipated to kill 670,000 head last week. We were only able to kill 665,000 heads. So, in all honesty, it's that inability to get these cattle processed more than anything else.
So what's the likelihood that that will ever change anytime soon?
Not anytime soon, but as we see employment increase, so that's the one thing that we note. Every time the employment rises, we have to know that somebody probably went to more work to the packing side of the industries there. So that's kind of what we're watching, and it's been very slow in rising. So we have to believe it's been very slow to the packers as well. But I don't think much is going to change until you get to the end of the year, and when September, when some of the benefits start to play out, if they're not renewed, then you begin to see a greater employment push.
Well, there is quite a bit of carry built into the market, is there not? You get into those fall and winter months, there's a big premium out there. Is that normal right now?
It is a little bit normal, but it's probably justified. When you look at the low placements that we are probably going to see in June and July, I can imagine that those October and December cattle might warrant those premiums there. And as we push forward, if the drought does intensify, unfortunately, we'll push more heifers into the placement mix and more cows into the slaughter. But if the drought subsides or is not as brutal as what it is, then we may find ourselves with a few less placed cattle this summer, and that might help our fall life on the fat cattle.
Okie doke. Well, thank you for talking with us, Chris. I appreciate it very much, and good luck trading today. Chris Swift of Swift Trading in Nashville. John, I will turn it back to you.